Before we dive into this in-depth breakdown of UnitedHealth Group, make sure to like this video and subscribe to the channel for more stock deep dives, earnings breakdowns, and long-term investment strategies across healthcare, tech, and energy sectors. UnitedHealth Group is a dominant force in the US healthcare sector, operating through two core platforms, United Healthcare and Optum. The company's most recent Q2 25 financial results painted a mixed picture. Revenue rose 13% year over year to $111.6 billion, driven by solid performance across both segments. However, adjusted earnings per share declined sharply to $48, representing a 40% drop compared to the same quarter last year, and significantly missing analyst expectations, which hovered near $4.45 to $4.40. The decline was primarily attributed to elevated medical costs, adverse reserve developments in Affordable Care Act exchange plans, and higher than expected costs in Medicare Advantage and Medicaid programs. The company reinstated its full year 2025 outlook, but did so conservatively. UnitedHealth now forecasts total revenue between $445.5 billion and $448.0 billion, alongside a much-reduced full-year adjusted EPS of at least 16. This sharp revision from prior guidance of roughly $26 to $30 reflects pressure from deteriorating medical cost control and one-time costs such as the $1.2 billion hit tied to ACA-related reserve adjustments. Notably, the medical cost ratio surged to 89.4% in Q2, up 430 basis points from the prior year, indicating that the company is spending significantly more to provide care. Operating margins in United Healthcare compressed from 5.4% to just 2.4%, highlighting stress across its insurance operations. On the cash flow front, UnitedHealth generated $7.2 billion in operating cash flow during the quarter, nearly twice its net income, underscoring the company's robust underlying financial engine. Its debt-to-capital ratio remains stable around 44%, and it continues to reward shareholders generously. During Q2, UnitedHealth returned $4.5 billion via dividends and share repurchases, with a 5% dividend increase to $2.20 per share. Although cost pressures have weighed on profits, the company maintains solid free cash flow. Management aims to achieve $1 billion in cost savings by 2026 through operational discipline and restructuring initiatives. From a technical analysis standpoint, UNH shares have broken below critical support levels and currently trade near 262. The 50-day and 200-day moving averages sit above the current price in the mid-270s, creating overhead resistance. The stock recently fell sharply on elevated trading volume following the earnings miss, suggesting institutional sell-offs rather than long-term investor flight. Momentum indicators like the RSI are approaching oversold levels, indicating the potential for near-term price stabilization or a technical bounce. Key support lies at $258, and a move above $270 could reignite positive momentum if fundamental conditions stabilize. Operationally, UnitedHealth continues to leverage its vast scale across insurance and healthcare delivery. The United Healthcare segment serves over 50 million people through individual, employer, Medicare, and Medicaid plans. Membership growth continues in Medicare Advantage and Medicaid, supporting the company's recurring revenue model. The Optum segment is more diversified. Optum Health, its care delivery arm, saw a 7% year-over-year revenue decline, mostly due to funding changes in Medicare and pricing misalignment in prior bids. However, Optum Rx delivered strong 19% revenue growth, and Optum Insight improved 6% as demand for healthcare. IT and analytics remain strong. Despite softness in Optum Health, the broader Optum franchise remains profitable and strategically essential to the company's integrated care model. The broader industry backdrop presents both headwinds and long-term opportunity. All major US managed care organizations, including Humana, Cigna, Anthem, and UnitedHealth, are grappling with rising medical cost trends, higher acuity in the aging population, and regulatory pressure. The Centers for Medicare and Medicaid Services are tightening funding and risk adjustment formulas, making it harder for insurers to maintain margins. At the same time, demand for value-based care, digital health tools, and predictive analytics continues to rise, positioning diversified players like UnitedHealth well for the long term. The company's breadth across insurance, pharmacy services and care delivery uniquely positions it to manage utilization and reduce per capita costs over time, though short-term headwinds will persist through 2025. From a risk perspective, UnitedHealth faces elevated uncertainty. The company is under scrutiny by regulators, particularly the Department of Justice, for its data handling and billing practices. Leadership changes also shook investor confidence earlier this year when former CEO Andrew Whitty was replaced by Stephen Hemsley, a former executive who returned to stabilize operations. In addition to strategic concerns, cyber attacks tied to the Change Healthcare subsidiary and underpricing in ACA exchanges have raised questions about risk management. Market sentiment remains cautious, with volatility expected until margin guidance improves or cost control efforts yield results. Further deepening the financial analysis, it's worth noting that UnitedHealth's balance sheet remains relatively strong, even amidst recent turbulence. The company holds approximately $25 billion in cash and equivalents and maintains strong liquidity through untapped revolving credit facilities. Capital expenditures have remained disciplined, averaging $800 million per quarter, mostly directed at digital infrastructure and expanding Optum Health's clinic footprint. These investments are aimed at improving long-term cost efficiency and patient outcomes. Moreover, the company's operating leverage still provides room for margin recovery if cost pressures subside by Q4 2025 or early 2026. Additionally, UnitedHealth has begun to realign its pricing and product mix in ACA and Medicare Advantage markets to reflect the new cost environment. This strategic shift includes reducing exposure to high-cost states and repricing plans to better match risk pool composition. Early indicators suggest that 2026 bids are coming in more conservatively, with less aggressive growth targets but improved margin assumptions. If UnitedHealth successfully executes this pivot, it could recover lost profitability and re-establish its reputation as a margin leader in the managed care space. While investor patience is required, these long-term structural adjustments reinforce the company's ability to navigate uncertainty and return to sustainable earnings growth. Taking a holistic view, the recent pullback presents a buying opportunity for long-term investors. The company's diversified business model, strong cash flow, leadership in both insurance and care services, and long-term cost management initiatives suggest the fundamentals remain intact despite near-term earnings volatility. If management can execute on cost reductions and drive Optum growth, the stock should re-rate toward historical multiples. While caution is warranted, the risk-reward profile now favors accumulation for investors with a 12 to 24-month horizon. Based on the Q2 2025 performance and updated guidance, we issue a buy recommendation for UnitedHealth Group.